Okay, so this is it. Okay, so therefore I will be using my tablet. So if any notes would be needed, I will put it on the board, not there, but on the screen, so it would be easier for you to follow. And the next thing we need to adjust a little bit or announce is the topic of your project, because I spoke with Janek last week, and he take over 5% of my from from the exam, which is fine by me, because his argument was that a lot of effort you need to put to pass the exercise, so maybe this is not very bad idea, but still 20% is for your project. So we figure out, I will send the list for you, but we figured out that we do have 7 topics. I think the group's supposed to be 3 person each, so I think 5 would be chosen and 2 is like for nobody. Okay, just to give you some sense of decision to make. Okay, here. So so the first is that the first subject is linked to Turkey, because this was one of the requests from you guys. So first is the lira exchange rate crisis and the policy response to it, and we posted some scientific papers for you. Yeah. Yeah, but I will send it everything to you. So the first is the lira crisis in Turkey, and we choose some scientific paper for you on which could be helpful to study the subject and make your essays. But this is not only literature in the world. Okay, so we choose some of the papers, and the rest is in your hand, if I may say so. So this is only the point of departure for you. Okay. Next is the Iceland and real exchange rate crisis, the monetary policy and exchange rate pass-through mechanism, and these are the papers for you. We not discussed, but only mentioned the Iceland at the first lecture, and no more space for this case on our lecture. So we thought that this could be nice subject for you. The third is East Asia currency crisis in 1997, 1998. So this is the third one. The fourth one is the Russia ruble crisis and oil price 2015. I know that Russia has no very good press for today, and nobody likes them. Fair enough, but still we do have some range of the cases which we can cover, and the crises were there where the crises were. Okay, so this is one of this one. The next is the Belarus and the game of anchors. About anchors, we would have some lecture. So I will discuss this one during our lecture. I don't know, it would be at 4 or 5 lectures. So this is it, and Belarus is one of the case. Don't worry, comment of Janek is fair enough, but you do not need to go for all mathematics. You can go for conclusion, literature review, and so on. Okay. So the next is the Mexico and tequila crisis, 1998, 1994, 1995, and Europe collapse of European monetary system in 1992, 1993. I think this one, I may say so, would be one of the easiest, due to the fact that we'll spend some time on it, but in the end of our lecture, so it could be too late for you. So, but still, we will cover this one, not very deep, but still, there is a special place for the withdrawal of the Great Britain from the ERM mechanism. Okay, so these are the subject for you. I hope I showed you the Sci-Hub last time. Yeah. Okay, so you're supposed to have the access to the papers, and you can, go to this paper, copy it to the Google Scholar, search for citation of the paper, for example. There are lots of articles connected to it, and so on and so on. So you can take a grasp of everything. You do not need to go very, very deep, like into the maths, because if we are going for some economic papers, this is hard for somebody who is not economician or economist, rather, because there is always some empirical models, some setup of the model, some equations, and so on, and they can be very hard for somebody who is not very familiar with economics. Okay, and yeah, you need to send me an email. I won't be respond to it right now because now is the lecture and I do not have any time for it. Yeah. Essay. This is the idea. We do not have any time for presentation, but if you are very, very, very wanted to share something with us, I will think it through. Okay. So maybe one lesson we can spend on the presentation. This is like first iteration of the essay process. So there is no very strict boundary. If we wanted to share what we know with the rest of the group, I think it would be very nice, but you need to participate in it. Not like I am talking to the wall and nobody cares and another person is going and make the speech and nobody cares and so on and so on. Okay, because in this way, in this sense, there is no educational effect there. Yeah, and I wanted from you to make a proper discussion on the subject, for example, and being interested in, and this is like what are we're here for. Okay. Yeah. If you have better idea than ours, yeah, feel free, no problem. This is no, you misunderstand me. I think you are very young. You have very young, bright mind, so you can came up with better idea than mine. No problem for me. Yeah, but here you have some literature. If you have some fair subject and you will find everything on your own, no problem for me. But you need to send your proposal to me and Janek, and we will discuss whether this is good idea. Okay. How long is it? 7 pages per person. I think this is fair enough. So for three person group, it is 21 pages maximum, because experience that, for example, when you are writing some scientific paper, you can produce a lot of pages and then you need to cut like half of it because the requirement of the publisher is that, for example, your paper cannot be longer than 25 pages at all. Yeah, so you need to cut. So 7 is quite enough. Do not go further. The smallest number, 0, for 0 points. So that is like you can start from this and expand it. Yeah, I think writing 7 pages through a whole semester isn't very demanding task to do. Yeah, and this is my perspective. So if you wanted to study the subject and read the papers. It's not very big amount of pages. And I know that there is, when you are starting the process, it could be very demanding due to the fact that this is the syndrome of empty page, or the first page. You have complex tasks to fulfill and something to write, and it is like you are reading and no idea in the head. Okay, so first idea is to put some citation of the papers into the Word file, and after reading the materials, you will collect, I don't know, 6 pages of citation. So this is like, you know, you can put it into the sentence and then it is easier to go. I think, just to be fair, I need to think it through to fix the date, but from our perspective, 2 weeks before exam, it is like the maximum, because we need to have time for read it and evaluate it. Okay, so yeah, for sure. If you want, you can give the essay before the Christmas, and yeah, but you know, I need to go to through the calendar and check whether when the session is started, and then, you know, calculate it back, and I will back with the fixed date. Okay, to you. Any other question? Okay, if not, we can go to our second lecture. So this lecture is more dense, if I may say so, because we would cover the first concept of exchange rate. What is the exchange rate about? What is the covered and uncovered interest parity? We would go for some equation and so on. So this is much more fun than the first one. So if I may say so. So the first thing is that we do have some question to consider during the lecture. Maybe we will answer them. If not, you can answer them on your own during after the lecture. What feature of exchange rate do we need to understand? So this is the first thing. Why this does matter? How does the foreign exchange market operate? And this is the second thing, because the exchange rate market is very huge. We would cover who is playing on the market, who is the subject on the market, what are the financial instruments there, and so on and so on. Okay, and then we would go to why do arbitrage and expectation matter for exchange rate. So we know from our macroeconomic lecture that our expectation play a huge role in the economics. Yeah, we covered it in the Phillips curve during this discussion about the expectation of inflation. So now we are going to think something about what do we expect about the exchange rate and their change. Okay, so this is what we would cover here. So first of all is that the exchange rate affect large flows of international trade by influencing the relative price of the goods in different currencies, and also affect international trade in assets. So this is due to the fact that, first of all, we know from our USLM model that we do have some exportation and importation. You cover all the international trade course, so you know that there is a exchange of goods and there are a relative price, and to know how much you need to pay, you need to express something in the same currency, if I may say so, in the same currency terms. I showed you in short sentences also that when you are trading assets, exchanging assets, the exchange rate means a lot of as well for your external wealth, as well as for your rate of return from the investment, okay? Because if you do have something in euro, for example, and you need to buy euro and exchange it, your dollars for euro, then when euro is more valued in terms of dollar, you have more of assets, okay, and your return is higher. So this is the idea why exchange rate do matter at all, okay? So in the foreign exchange market, trillions of dollars are traded each day, and the economic implications of shift in the market can be dramatic. So when we express some very big depreciation, for example, we know from the Iceland case that the crisis can come into our country and devastate whole economy, for example, for some time. Yeah. So we begin to study the nature of impact of activity in the foreign exchange market. So the topics is as follows. So exchange rate basics. So we will learn something what exchange rate is, how it could behave, basic facts about the exchange rate behavior, the foreign exchange market, and arbitrage and expectation. Okay. So this is important for us. So what is our exchange rate? So our exchange rate is the price of some foreign currency expressed in terms of other currency, okay? In our case, we would discuss it like how much of home currency you need to pay for foreign currency, okay? So this is the price of foreign currency in your home currency. So because an exchange rate is the relative price of two currencies, it may be quoted in either two ways. So we have the direct quotation and indirect quotation, okay? So the first is that we do have the number of home currency units that can be exchanged for 1 unit of foreign currency. And the second, which is like turned upside down, the number of foreign currency units that can be exchanged for 1 unit of home currency. So the first, like direct quotation is, for example, 5 zloty per $1, okay? The indirect quotation would be 0.2, $1 is equal 0.2 zloty, other way around, sorry. $0.2 is equal to 1 zloty. So this is the term, okay? First is our home currency to foreign currency, the second is foreign currency to home currency. So to avoid the confusion, we need to decide which we would use. So in this case, we would rather go for home currency in the terms of foreign currency. And this was also the example of at the first lecture when we discussed the depreciation and appreciation. I asked you whether this is appreciation and depreciation, and we use exactly the same terminology like now. So the definition is as follows. So when we refer to a particular country exchange rate, we will quote it in unit of home currency per unit of foreign currency. Okay, so these are two examples. For example, we do have here the dollar and Japanese yen. So we are from the perspective of US into Japan currencies. Okay, and here we have the Danish krone per €1. Okay, so this is our perspective. Okay, so here we have some exchange rate quotations, and on the left hand side we do have some currencies. This is between 2014 and 2015. So 2014, which is the previous year, is in here. This is the column 4, 5, and 6. An exchange rate on December 2015. So 1 year after 2014 is 1, 2, and 3. Okay, and here we have the Canadian dollar in terms of US dollar, euro, and pound, British pound, and the second is in here. Okay, so we can see that the direct quotation is that for $1 we need to pay for €1 we need to pay $1.086. Okay, so this is the American terms. If you wanted to go for Eurozone, so this is 0.921 dollar, 0.921 euro is equal to $1. So we can see that this is like 1 divided by the second exchange rate from the second perspective. Okay, and this is exactly the same in here. So looking at this exchange rate table, I will ask you in terms of, for example, euro and dollar, which is in here, whether it was a depreciation of or appreciation of the euro against the dollars. Why? In 2014, you have here, yeah? Here is the 2015. Yeah, because in here you need to pay 0.8 euro for $1. Now you need to pay 0.9 for $1. Okay, so this is depreciation of the euro in this case and appreciation of the dollar. Okay, so we can go for this way or that way, like appreciation and depreciation, but the main conclusion is exactly the same. Okay, so this is like in economics, you're supposed to know the terms zero-sum game, for example. Okay, if euro is winning, dollar is losing. If dollar is losing, euro is winning. So this is the zero-sum game. Okay. Yeah, we will go for that in a minute. Yeah, so if one currency buys more of another currency, we say that it has experienced an appreciation. And I know that this is very boring, but I would ask this question like 1,000 times, whether it is appreciation or depreciation, because this is like fundamental issue for us. Okay, and if you lost in here, it is like completely lost game for you. So we also might say it has risen in value, okay, appreciate or strengthen against the other currency. So these are the term in the newspaper, for example, or in the internet, which we can follow, okay. So on the other hand, we have depreciation, so lost in the value, okay, or weakened. So in case of Polish zloty and dollar, in last, I don't know, few weeks, we had appreciation or depreciation of zloty. Yeah, and it was huge. So, and it was, this is not that, yeah? Yeah, you know, because yeah, you know, I'm not the responsible for the decision of monetary policy board. If I would, the situation could be different. But as economist, I may say that it was due to a few factors which we would study here, okay? Because the facts are that, first of all, the monetary policy do matter in the long run, and we would cover it in, I don't know, 6 or 7 lectures. So this is the first thing. The second thing is that the level of inflation play matter in case of exchange rate. And the second and the third, which is not connected with the decision of central bank, but rather the Ministry of Finance, was that we would tax each company for enormous benefits from the war. Okay, and this was the immediate reaction of the stock exchange market, which go down very deeply after announcing this one, because there is no project in the parliament, there is no I don't know, consultation whatsoever, there is nothing. Some guy told something, and this was the reaction of the market. Okay, so Warsaw Stock Exchange market go down, and it was immediately depreciation of the Polish zloty. So this is how you can affect the decision, not only by the monetary policy, but also by the expectation which is very important for us, and by announcing some ridiculous taxation issue. Okay, so this is three things which happened. But in case, for example, I am from the my scientific interest is in international trade. So if Polish zloty is weaker, our export is thriving. Yeah. So this is why I am happy.
But it's not going to be introduced, and it's not just a reaction of the market, but something that is not quite
Yeah, but you know, when you are thinking about political system, you wanted your party to deliver the promises, yeah, and this is good stuff. But in case of our present government, the very bad thing is that they deliver their promises. So in this case, each promise was delivered, and the effect of these promises isn't like 100% positive, if I may say so. So this is one of the promise which has very negative effect on the market. So this is why, okay, because market learn that if they say something, it did happen, okay, and this is like in regular democracy, this is something you wanted to have, but not in each case. If in case of this government, nothing is impossible, and we experience, you know, we experience the regulation during some night, during some, I don't know, break for supper or time or whatsoever. So I don't know. Yeah.
So reaction like that, in my opinion, it's quite unlikely to introduce extreme that.
Yeah, but the assumption makes sense if you care. Yeah, if you don't care, you are like. Yeah, you know, you're at political science faculty. There is a very big and very good chair in our faculty of economics, which is the political economic department. And there is a lot of models which shows that political parties maximizing their voting results, so they don't care. Okay, it doesn't matter how hard it hits the economy, how hard the people is suffering. The only thing it's matter is that we maximize our voting power. And if you understand this, you are putting less anger on the discussion, for example, because you know the mechanism. You know the mechanism, and this is in somehow rational mechanism from their perspective. Okay, but only this perspective matter. Yeah, their perspective. No, not whole economy. But I don't know. I hope not, because this is like going to very deep of communism, and we know how Venezuela is going right now. Yeah, so we do not want to be there. Okay, so in going back to our lecture, in US terms, the following holds true. So when the US exchange rate rises, more dollars are needed to buy €1. The price of €1 goes up in dollar terms, and the US dollar experienced the depreciation. This is what we discuss in the table, okay? And this was my question. So other way around is when there is a fall of the exchange rate, okay? So we won't be going with this. So in here we do have some numerical example. Let us imagine that in 2014, so which is time t, we do have the dollar value of the euro was 1.211, okay? And in t+1, which is the next period, we do have 1.086. So we know how we can calculate the change, okay? And I showed you at the macroeconomics as well as international trade how we can calculate the percentage change of the variable. So how we can do this? Everything is on the screen, but maybe we can stretch our brain. Let us imagine that we do have some variable x, okay, in time t, and we do have the same variable x in time plus t plus 1. So we wanted to calculate the change of the percentage change of t. Okay, yeah.
So it's t plus 1 minus x t divided by.
Yeah. And multiple by 100% because we wanted to have this in percentage term. So this would be like x t plus 1 in percentage term. Okay, so this is it, and exactly the same is in here. Okay, so we do have separate steps here. So here is the difference between x t plus 1 and t, and here we divided the value, okay, just to get the percentage term. So we can see that the effect is minus 10.32%, which means that you need to pay less of your currency. This is the reason why we do have here minus, okay? And if this is the case, we are experiencing the appreciation of the euro in this case, okay? The dollar against euro. So the dollar is appreciated here because you need to pay less, okay? And this is consistent with our convention that we are talking about home currency in the terms of foreign currency. Okay, but let's make an experiment and change the quotation from euro term to dollar term and see what happened, okay? So we do have the euro in 2014, which is 0.826, and this was the value from the table. The same is for 2015. We are calculating the change, so we can see that this is the plus, and divided by the value from period t, which is the percentage change, and we do have plus 11.50%. So the euro depreciate against dollar by 11.50%. So if we can see, this is not the same as 10.32, okay? So this is the difference here. In case of huge transaction and the main currency, the difference is not very big, okay? So we need to discuss which convention we are using and be consistent with that, okay? So this is like the way of measurement the increase of the GDP, like on macroeconomics or inflation change, okay? We need both measurements are correct, but we need to decide which one we wanted to use. And I think from our perspective and from the perspective of daily currency users, the easiest way is the first one, yeah, the direct quotation, because if you are in some country, at most cases you do have the direct quotation, okay? So this is the way how we would calculate, okay? So we would stick to this one rather than this one, okay? So this is our arrangement here. Another thing is that we can have multilateral exchange rate. So in this case, exchange rate changes by aggregating bilateral exchange rates using trade weight to construct the average over each currency in the basket. So this is the way of calculating the effective exchange rate for some country, okay? And this is due to the fact that the currency matter in two cases for us, okay? First is when we are changing assets, exchange assets internationally, and the second is when we are trading, okay? If we are not trading and have no external assets, exchange rate doesn't matter for us, okay? Because there is no interaction with the rest of the world. So in this case, we do have some measurement which can weight the change in our home currency term by weighted it by our trading partners. So let us imagine here that we are trading with 40% of our trade is with country 1 and 60% is with country 2. Therefore, this is our calculation here. Okay, home currency appreciate. This is minus 10%, exactly the same convention as previously. So we are paying less of our currency for 1 unit of another currency, so against one, but depreciate against the second one. Okay, and we wanted to know whether this is a positive effect for us or not. So we are weighted it by the share of trading partners. Okay, and then calculate the effective exchange rate. Okay, so we can see that our appreciation of 10% and depreciation of 30% is resulting in depreciation only in 14%. Okay, because we can see that this is a huge change, and this country weight more in our trade than the first one. Okay, we can make other experiments. So if you wanted to go, for example, for World Bank data, you can choose whatever country you want. You can calculate the share of the trade with major, for example, 3-4 partners, and then calculate the percentage change of their currencies, okay, for period 1 and 2, and check what is the effective exchange rate. One of the things you're supposed to know is that when you are going for the World Bank data, for example, there is something which is LCU. And this is something what I will show you. So this is like X. Okay, we can find something like this one. And this LCU means that this is the local currency unit. Okay, so for example, when you are choosing Poland from this set of the variables, we do have Polish zloty per US dollar. If you are going for Turkey, there is Turkish lira against US dollar. Okay, so local currency unit. Okay, so this is how we can find the data, and there is no like very easy explanation what this LCU means. So if you are the user of the data, I think it is useful information for you. Okay, so this is like effective exchange rate, and this is only two country case example, very easy. So we can go for like general idea here. So in this case, we would have the trade, and this is the sum of the trade with our trading partners, and then we are establish what is the share of country 1 in whole trade, what is the share country here supposed to be 2. Okay, what is the share of country 2 in trade, what is the share of country N in trade, and what is the change in exchange rate. Okay, the nominal exchange rate, and then we can calculate the change of effective exchange rate. Yeah, did I send you the booklet of yeah, okay, because I do not have this on my memories, so I need to check it. Okay, so this is the, for example, but do we need to calculate for each partners? For example, when we do have 220 countries in the world, so for example, I don't know, Poland could trade with 190 countries, for example. Yeah. So do we need this all? Not really. Yeah. We need to have the major trading partners. So this is the example of multilateral exchange rate for United States. So the blue line is the nominal effective exchange rate for basket of 26 currencies. So these are 26 major partners of United States. And the red one is the only 7 partners. So we can see that this is like 16 more countries making this difference, okay? So pretty enough, we can focus only on 26, even on 7. It is very good approximation for us. We do not need to go for 220 countries, okay? So in this case, like we told, there is the appreciation and depreciation in this case, okay? So this is foreign appreciation here, and this is foreign depreciation in this case, okay? So we can see that the effective dollar exchange rate from 2001 till 2007 has the trend of dollar depreciation, okay? And then after 2011, small or consistent appreciation trend, and then skyrocketing value in 2014, 2015, okay? So this is how the trade data looks like. Okay, and now we can go for some example. So for what we do have the exchange rate and how we can compare the price of the goods, because what we are interested in is the relative price of the goods, okay? So let us imagine that we do have some James Bond or some whatever, and now we can imagine that this is the agent 007 because it is well fitted for women and men, and this is like better example than James Bond per se, but 007 is fine. So 007 wanted to buy tuxedo for whatsoever purpose. Tuxedo is some very, very elegant suit. Okay. Yeah, this is smoking in Poland, but tuxedo in English. Okay, so we do have the cost of tuxedo in local currency, and we have 3 markets. We do have Great Britain, which is London, and we do have pounds. We have Hong Kong, and this is the Hong Kong dollar, and New York, which is US dollar. So we need to think where is the best to buy tuxedo for James Bond, okay? Where is the cheapest price? So this is the interest of Great Britain government, if I may say so. So we do have the exchange rate. This is the Hong Kong dollar per pound and US dollar per pound, okay? And we can calculate the value of tuxedo. So the exchange rate was chosen that in each market, the cost of tuxedo is exactly the same. We are not thinking about transportation cost here, okay? So there is no trade friction. So you can teleport and buy the tuxedo or whatsoever. So the cost is exactly the same. Now we can see that the exchange rate changed in here, okay? Which means that we need to pay more Hong Kong dollars per 1 pound. So this is the appreciation or depreciation of the Hong Kong. Thank you very much. Very good answer. So this is the depreciation. If this is the case and Hong Kong dollar depreciate, the price of tuxedo in Hong Kong goes down. Okay, so this is one of the important conclusion here. The second is that we do have $2 per pound, and now we do have $1.9 per pound. And this is appreciation or depreciation, and you cannot say it because, okay, thank you, because I need other persons as well, okay? Yeah, appreciation. So if this is the case, the cost of New York tuxedo is going up. So we do have 3 markets here, and we have the lower price in the Hong Kong and the higher price in New York, okay? And there are also some other experiments, okay? So we are going other way around to check. So this is the depreciation of the dollar, appreciation of the pound, and the prices are like going other direction, okay? In Hong Kong is more expensive than in London and then in New York. And we do have also appreciation against two exchange rate, and the price is going up. So three major conclusions in here. The first thing, which is quite obvious in here, is that no matter how exchange rate behave, the local price expressed in local currency does not change, okay? We can see that in London, tuxedo in 4-case scenario is exactly the same. So this is the first thing in here. The second is that when we experience appreciation of foreign currency, the price, relative price is going up, okay? And the third, when we experience depreciation, the price on foreign market go down, okay? And this is the reason why we care about the exchange rate, because we want to have the price of some good in common currency term, okay? So exactly in the same currency, no matter what the currency is, okay? We decided to go for home currency against other. So we are expressing everything in pounds, which we can see in here. But it doesn't matter, okay? The matter is that we need to have one common currency, and all three conclusions hold, okay? Okay, now we need to think through about the regimes of the exchange rate and the pegs, okay? So I have a few examples for you in here. So at the first lecture, and maybe from your head, we know two extremes, yeah? What are these extremes of the exchange rate regime? Yeah, so these are two extreme, yeah? Floating means we don't care and the market set the price of our currency, and fixed means that it need to be stable, okay? So fixed is called also a peg, pegged exchange rate. So in this case, fluctuation is in a narrow range or not at all, okay? Because fixed does not mean that you have set the exchange rate stable all the time. You can go with very small boundary, for example, plus minus 1% percentage point, for example, okay? This is pegged as well. So we do have some other not so very extreme cases of pegged exchange rate, okay? And we have also flexible. So exchange rate fluctuates in a wider range and the government make no attempt to fix it against any base currency. So base currency means the most important currency in the world, which is, this is the first, what is the second? Yeah, and two more. Yeah. Nope. No. Yeah, Japan yen. So these are four. Yeah. I know that there were some attempts of China to put their yuan into the basket of the most important currency. Yeah, but for now with no success. Okay, but with China, this is very very nice case because they do have two exchange rates. One is for exchange rate on local market, and the other way is for export and import. So there are two exchange rate there. Okay, so here we have the behavior of the free floating exchange rate. So we do have some currency pair, which is US dollar and yen. US dollar and pound, and US dollar and Canadian dollar. And what we can conclude from these charts? Yeah, but this is like tendency of the dollar. What is the behavior in each of the graph here? There is a common feature of each graph. Yeah, so this is very big variance. Yeah, we can see that it can change the value very rapidly. Yeah, like in here, then from here to here. Okay, so we can see that this is like very stable here and rapid change, shoop. Yeah, and this is exactly the same here. So the variance of the exchange rate is very big, okay, wide. So this is like, if you are going, for example, to hospital and go for EKG treatment, this is the measurement for of your heart. You can get also some lines like this one, okay? So this is like free floating, if I may say so. Okay, in here we have the exchange rate behavior of the euro per yen, euro per pound, and euro per Danish crown. And we can see that euro was introduced in 1999, but in here we do have the floating exchange rate, okay, as well as in here, but with lower magnitude. Yeah, the variance here is lower, but in here we do have the Danish crown, which is fixed against euro, and we can see that this is not a straight line. There is some movement in here, okay, especially in this point and in this point. This means that the exchange rate is bound, and the boundary is in here, and we can see this 0.14, 0.13. Okay, so with this within this bound, the exchange rate can move. Okay, but it's not very straight line. And okay, other cases, this is the Indian rupee and Thai baht and South Korean won. So in here we can see that we have some managed move in here, and we are going with some trend in here. Okay, so we can move, but with the very close range of the trend. Okay, so this is like managed float. Here we have the very big change, which can give us the financial crisis perspective. Yeah, so this is the rapid change in here. So it was depreciation or appreciation. Yeah, and very huge, from 25 till 55. It is almost 100%. Yeah. So, and then there is some trend in here. Okay, so it is like smoother. The same is in here with I think two crises in here. Okay, and the last thing is in here. So this is like crawling peg, and here is like very stable, which is fixed, then change, fixed, very big depreciation of Argentina, and then depreciation of Argentina. And we know that Argentina has bankrupt 7 times, and it is on the edge of next bankruptcy right now. So this is like very, very nice case for us as economists to describe. Not very good case of country to live in. Yeah, there due to the change of their exchange rate. Here is the Colombian peso, which was going with the trend. This is depreciation and then some appreciation, and this is very nice case. In Ecuador, it was very big depreciation, then more depreciation, which gives us the perspective of crisis. Here we have 1 year of fixing, because this is the straight line, and this was very tight fixing, and by the end of 2000, there is no exchange rate because this process is called dollarization. And dollarization means that you are using other country's currency, no matter what the currency is, and you do have no central bank, no monetary policy there. And the terms is that in most cases there is the usage of American dollars, but also could be other currencies. Okay. So yeah, the exchange rate regime in the world. So I will show you the numbers of the regimes in the world right now. So there is a IMF classification of exchange rate regimes around the world. So we do have 2010, year 2010, and 182 country economies, and 6 of them has a currency board. So when we would talk about the banking crisis, if we do have time for it, we will describe more carefully the currency board, okay? But this is the type of very, very strict, hard, fixed exchange rate, okay? And this is very stable and has some advantages and disadvantages, and we will cover also whether it is better to fix or not fix. Okay, so what is our intuition? Okay, because I think I told it not last week because you were absent here, but 2 weeks ago. At most cases, the countries do have the fixed exchange rate or free floating. Yeah. So this is the good idea. This is the good answer. So if this is the case, we would think what are the benefits from it, because if most country has fixed exchange rate, maybe there are some benefits. Okay, so the first set of country has no spread and legal tender. So this is the most fixed exchange rate, and in here we do have the currency unions. So the first thing is Eurozone, because none of these countries has the power to change the interest rate and policy of the Eurozone, only the European Central Bank. We have here, for example, the Eastern Caribbean Currency Union, West African franc zone. So these are the most strict, okay, and it concerns at most cases the currency unions. Okay, then we do have 6 of currency board, which is Hong Kong. This is like, I think, the most important country in here, due to the fact that it contains 3% of world trade, and this is very, very small country. Okay, then we do have the other pegs, which means, for example, China is in here, Costa Rica, Denmark. Denmark is also like with the fixing against the euro, and so on and so on. Then we do have the band crawling peg, and we do have the country like Algeria, Angola, and so on and so on. Then we have wide band managed floating and free floating in here, and there are 46 countries here. Okay, so exchange rate in the world over are set in the foreign exchange market. So this market we would call FX market, and we would extend our ESLM model in further our lecture by the FX market. Okay, and I will show you how to do this, because this is quite important, and then we can finally understand how, for example, decision of the monetary authority, which is like central bank in some country, and for example, printing money can influence the exchange rate. Okay, and this is quite useful tool for analysis of the current economic situation. So the forex market is not an organized exchange. Trade is conducted over the counter. In January 2013, the global forex market traded $5.3 trillion per day. So now it is 6.
Yeah, but maybe leverage transactions and so on.
I need to check this out, but I have the charts for you. This is I gave you here the source. This is Bank of International Settlements. This is like bank for banks. Okay, at this page, you do have all pages of central bank all over the world or OECD banks. So, for example, if you wanted to go to the central bank of Egypt, there is the web page there, and you can go there and read everything. So, in here we do have the 6 trillion US turnover in 2019. Okay, and spot was 2 out of 6. 4 was the FX swaps, and we would discuss this one. And the major currency markets is in here. Okay, so the pink one is the London market. Another is New York, then Singapore, and yellow is Tokyo. Here is Hong Kong. The colors are different on my screen, but the lamp is like it is. Okay, so these are the major markets of FX transaction, and who is playing on the market. So in this case, we do have in 2001 the majority of the transaction were done by reporting dealers, which is financial institution. Okay, and other financial institution was in here, like almost 30%, and here are non-financial customers. So we can see that this is these are financial institutions, and these are the rest of the world. And along passing years, we can see that the rest of the world share drop, and other financial institution share goes up, and here we have downturn in reporting dealers. Okay, so now the conclusion is that financial institutions are the major player on the markets, and they are traded even more than in previous decade. Okay, so if you are more interested in how the FX market is going and read a full report, go to this PDF file. Okay, I don't know how many pages, 30 pages I think it is, but if you are interested, this is available for you. So the simplest forex transaction is contracted for the immediate exchange, so like on the spot. So of one currency for another currency between two parties, this is known as a spot contract. So spot contract is like, for example, when you are going for your vacation, you wanted to exchange your money for the money of country of destination, and this is the spot transaction. Okay, the exchange rate for this transaction is referred as a spot exchange rate, and this is imported exchange rate from the perspective of our further analysis. So the use of the term exchange rate always refer to the spot rate for our purposes unless otherwise noted. Okay, so I will inform if this is not the case. So the spot contract is the most common type of trade of appears in almost 30% of all forex transactions, and we sold it. Okay. Another thing, or another asset which we can have on the financial markets are derivatives. Do you know anything about derivatives? Because, for example, stocks, bonds, this is the most common tool on the financial market, yeah. But derivatives are also very important.
Maybe they're about not one object, but about relation of two instruments.
Yeah, very good idea. So derivatives is the price of the instrument derive from the price of something else. Okay, so for example, we can arrange the exchange of, for example, I wanted to sell you a pig, yeah, and I am telling you that the price of the pig in 2023 would looks like this one, and you are saying, okay, so let's contract this one, and for example, at some date, I am going to you with a pig and selling with this price. If the price is higher, it could be, but it is more complicated. Okay, we do not have more time for going into the deep. I will show you only some definition, but some instruments can be very complicated. For example, in Poland, few years ago, one of the popular asset was something like polisolokata, which was the relating your deposit with insurance or insurance deposit, something like this one. At most cases, everybody lose, apart from the institution which sold this one. And you need to be careful, because when you do not understand the instrument, how it is working, do not go there. Because, for example, I was on some of training from insurance, and the agent of insurance agent showed us the insurance policy in which this is a policy, but in fact, it was a contract between the insurer and me, and I was the deliverer of the option in this contract. And if you are the deliverer of the option, you have obligation to deliver it. And he has the decision whether I need to deliver the instrument or not, okay? If the condition is not good for the buyer of the option, we do not go there. If it is profitable, we are going there. Okay, so this is the reason why we need to focus on it.
They actually have the option part is was blocked from the start, the kind of blocked from the start, that might not be able to start at the event.
Yeah, there were a lot of issues there. We won't go there because it is very complicated. Yeah, but at that point it was legal. I don't know if there were some court suit there, but I know that the financial supervisory wasn't very good prepared for that kind of instruments, and a lot of people lost their money, not for the first time. So if you are seeing some very big interest rate or rate of return from the investment, don't go there, because this is scam for sure. And if you do not understand something, don't go there. Okay, it is better to not use the opportunity than lose everything, because this is the case there. Okay, so we do have few instruments. So forwards, swaps, futures, and options, and we will put some basic definitions there. This is the exchange rate, and here we have the spot rate and forward rate. Okay, so forward is one of the instrument, and spot rate is like on the counter. So we can see that there is a co-integration between the time series here. So they are moving exactly the same. Okay, not only the same direction, the same movement, but the values are pretty perfectly the same. Okay, and this would be important. So forward is the contract, differs from a spot contract in the two parties make the contract today, but the settlement date for the delivery of the currency is in the future. But it not necessarily need to be the currency. We have the currency case because we are on international finance, but as I said, it could be pigs, for example, pig's meat. I don't know. There is a lot. So wheat, pig's meat, coal, whatsoever. Okay. The time to deliver or maturity varies. So, however, because the price is fixed as of today, the contract carries no risk. Okay, so we know exactly the price at which we are selling something. Okay, and it is not standardized, which means that the maturity varies due to the fact that this is our arrangement. Okay, nobody cares what is our arrangement as a two-party. What is important are swaps, because swaps are particularly connected with the exchange rate and the currency prices. Okay, so this is the contract in which I am deliver some foreign currency to you at some exchange rate, and after a while you are deliver it or sell it back at some other exchange rate. Okay, so this is to minimize the exchange rate risk. Okay, and reduce the costs. So for example, we can go like trade, make some export-import contract, and to eliminate the risk or ensure our profits for the transaction, we are making a swap transaction as well. And we can see that swap transaction was very high in the value of FX market here. Okay, so they were the most important in here, but now, yeah, still the most important on the FX market. Okay, we have also futures and options. Okay, so a future is a contract is a promise that the two parties holding the contract will deliver currencies or other goods to each other at some future date at a perspective exchange rate, just like a forward contract. But unlike of the forward contract, futures contracts are standardized, which means that the maturity of the contract, the regular dates, and so on are fixed, standard, and can be traded on an organized future exchange. Okay, so this is the main difference. The first, the forward is not standardized, and we can make whatever arrangement we want. But in case of future, there is a standard date, standard maturity, and so ever and so ever. Okay, and then we have options, and options we have two options. So provide one party, which is a buyer, with the right to buy, okay, or right to sell. So if I am a buyer of the option, I have a right to execute it, but the deliverer need to execute it. Okay, there is the requirement of it. So a currency in exchange of another at a perspective exchange rate at a future date, the buyer is under the no obligation to trade and will not exercise the option if the spot price on the expiration date turns out to be not favorable to him. Okay, so for what the option was invented, so there are two parts. First is hedging, which is risk avoidance, and another is speculating, okay, which is searching for a risk for extra payment for you. Okay. So in case of hedge, we do have some example here. So a chief financial officer of a US firm expect to receive payment of 1 million in 90 days. For your firm will incur losses on the so the current spot rate is $1.2 per euro. Okay, so our firm will incur losses on the deal if the euro weaken to less than 1.10. Okay, so there is some vendor in which we are earning, which means that 1.19, 1.18, and so on and so on. But if we are in here, we are zero profit, but further weaken of the euro means that we are losing. Okay, so we are buying some million call option on the dollar at the rate 1.15. Okay, so we are ensuring ourselves that at least we are earning something. Okay, yeah, so this locks in a minimal profit even if the spot rates fall below 1.15. Okay, if it would be, for example, 0.9, we can execute the option and make a profit. If it is like 1.4, which means we earn more, we do not execute the option and then earn more profit. But the minimum profit is ensured in here. So this is as a buyer, no. As a deliverer, yeah, you need to. So
the buyer would be the hedge fund, would be the buyer, but
yeah, our perspective is we are the buyer. Okay, we are the company, financial stuff from our company. We are buying options in here. Okay, and who is delivering it doesn't matter from our perspective. Yeah, but the option has the standard days and it is locked for 90 days. Okay, so it is standardized. We are arranging that after 19 days, okay, in day 90, we are whether execute or not. Okay, if we are not executing, the option expires. Okay. Yeah. Yeah, you need to deliver the money because you are buying the option, but it's more complicated. In this case, you are not losing anything. Okay, this is the hedging. But another thing is when we are speculating. Okay, and we are buying swaps. So this is the example when we are buying swaps and we are betting how would be the exchange rate in the future, like 12 months in the future, and then we are checking whether we were right or not. Okay, and this is the speculation because we can gain something or lose something. Okay, it depends. So this is like betting. Okay. Okay, so private actors, most forex trade work for commercial banks. About 75% of all forex transactions globally are handled by just 10 banks. So the biggest one. The exchange rate for these traders underline quoted market exchange rate, and some corporation may trade in the market if they are engaged in the extensive transaction in foreign markets. Okay, so we saw that the other, like the rest of the world, has some share of the transaction on the market, and now it dropped down. Okay, so the biggest players are the financial institution there. We can also have some government actions in this case, in this regard. So some governments engage in policies that restrict trading, movement of forex or cross-border financial transaction, and this means capital control. Okay, when the capital control occurs, so some central bank need to defend the the policy and be prepared to sell its own currency to maintain the fixed exchange rate. Okay, so this is like not very convenient for independent central bank, but in this case it could be needed. And the capital control means that you do not allow people to trade with unauthorized, for example, transaction. And this is case of Lebanon right now, for example. There is two exchange rate there. There is an official exchange rate and unofficial exchange rate. The official exchange rate you can check in internet. And this is the fixed exchange rate, the Lebanon lira against US dollar, okay? But everybody knows that this is not the real exchange rate because everybody is traded with different transaction. It is like 10 times higher, okay? You need to pay 10 times more lira than the official rate. So even though you can go, for example, to the grocery and exchange money there, there is also some online app which you can download and check the black market exchange rate. Yeah, but Iran is cut from the international monetary system, okay, and from the bank. So this is quite different. I know that there is some issue there, but they are like cut from the system, and Lebanon isn't. Yeah. Officially, yeah.
On the market, you can buy this because there is exchange rate, this is for this, and this is for this, and then you can buy this.
No.
If there is,
No, it does mean that if you are wanted to go for the transaction, you need to use the official exchange rate, yeah, if you are engaged with government or whatsoever. But private institution and regular people has another exchange rate, and this is the real exchange rate. You cannot buy anything with the government exchange rate. It is too low, okay? So they overvalue the Lebanon lira against dollar, and the Lebanon lira is worth almost nothing right now. Yeah, yeah, but nobody cares about it. And in Poland, it was the same. The capital control to express the view of it was the cinkciarz on the street. You cannot buy dollars. Only government has some dollars and can exchange the dollars, but not very keen to do this. But you can go, for example, to East Railway Station and buy the dollars with an official rate on the pavement, yeah, on the street. So this is the capital control, and we can see that this is like almost impossible to force people to do this because nobody wanted to make it. Okay, I think we do have two minutes, yeah. So arbitrage and spot exchange rate. So I need to give you some idea because otherwise Janek kill me. So so arbitrage and the spot exchange rate. So in this case, let us imagine that we do have the New York and London exchange rate, and we wanted to have exactly the same amount on each market. Okay, otherwise the speculation is possible. So we do have $1 in New York, and we wanted to have B when we exactly the same. We wanted to go in here. Okay, so let us imagine that our $1 is sell for £1 in New York, yeah, with the New York exchange rate, and this is how many pounds we are getting. Okay, but we can go also to another market, which is London market, and we do have our dollar here, we can transfer dollar to London, okay? Sell the dollar for pound in London, then get pound and transfer it to New York, okay? And we wanted to have exactly the same amount in the end of pounds, okay? So we want to have exactly the same amount of money, no matter on which market we are trading, okay? Otherwise, there is a possible to speculate.
What about the fees? Transaction fees?
Could you be more precise?
We want to transfer one currency like 2.3 trades and time-based transaction some fee.
Okay, so this view you are thinking about. So you are to haste because the three currency speculation is like 3 slides ahead of us, and I will give you the example. Okay. So this is the arbitrage with 3 currencies. Okay. So we do have, for example, direct trade from dollar to pound. So this is the better, right? 3 examples are in here, okay? We can go exchange pound for euro and euro for dollars. So the indirect trade is better. So this is higher rate. And if everything is exactly the same, this means that we do have the no arbitrage condition, okay? And no arbitrage condition means that the direct exchange rate and cross rate are exactly the same, okay? So no matter which way you are going, you are getting exactly the same. And this is the no arbitrage condition. And this would be very important for us for the next time. And I think, yeah, this would be the case of 3 currencies. We would stop in here and then we will continue next week, okay? Thank you very much.